Hi, thanks for joining me again. It's Adam Gower, and today I'm going to go through the internal rate of return part 2 by showing you how to use this incredibly complicated and difficult to understand concept really easily in order to be able to compare one deal against another, and also how to compare one sponsor against another and to understand how much are they taking out of the project, right? It's just one method that you can use that's a really useful tool. So let's go back real quick. This is the Small Change website. This is the Tiny House project. You'll remember that we took a look at actual returns. Even if you don't understand the concept, like I said in the last video, it's an extremely difficult concept to understand, but there are two ways that the IRR is used that you can utilize very simply. And those two ways are, number one, it is used at the deal level, the project level. And number two, it is used at the investor level. So if you have both of those IRRs, the deal level or the project level and the investor level, you're going to be able to tell exactly how the sponsor is treating you, right? So let's take a look at this Excel spreadsheet. I'll keep this really simple. So over here, you can see here is the project level IRR. You don't really even need to know what the IRR means to get something out of this number. So the project level IRR, just ask the sponsor what's that going to be. In this simple example, it's 18%. Then you have the investor level IRR. Okay, that's the IRR that you are going to get once the project is finished. The delta between these two is the project level minus the investor level. Okay, what is that number? That number is what the sponsor is taking out of the deal, period. There is no other way that those two numbers can vary. All right. So if the project level is 18% and the investor level is 18%, that would mean that the sponsor is taking nothing out of the project other than fees. Okay. Now, if there is a difference, which there is in every single real estate deal, there is going to be a delta. And in this example, that delta is 4%. As a percentage of the project level IRR, that's a 22% variance in this example. What that means is that the sponsor variance is 22% in this example. So what you can do is you can look at the project level IRR and the investor level IRR, and you can calculate exactly what that delta is and then compare it against project level IRR to see how much relatively, not including fees, is the sponsor taking out. And I have seen massive variances in this. I've seen anything from 8%, which is a very small amount, right, for a sponsor in this calculation, looking at this variance or this ratio. And I've seen all the way up into the 30s, where the sponsor is taking more than 30% of all returns in the project. All right. So it's a nifty trick. It's very useful. You don't even need to understand what the IRR is to be able to calculate that ratio. Having said that, go to leadersofthecrowd.com/small change, where you will get access to an extremely detailed explanation of not only the IRR, but of every other key financial term that you need to know in real estate investing. That is it for today's video. I'll see you in the next one. Thanks a lot.